Let me tell you about two people who both call themselves investors. The first one has $1,200 in a brokerage account he opened 6 months ago. He checks it every morning before work. He's got 4 stocks, a crypto wallet, and a Reddit app he refreshes more than his email. The second one has $10 million spread across index funds, private equity, real estate, and the bond ladder she set up with her financial advisor. She checks her portfolio roughly once a quarter, sometimes less. Both of them call themselves investors, but they are not living the same life, not even close. And today, I want to walk you through every level between those two people. Not just the numbers, the actual life, the mindset, the problems, the things that change at each rank that nobody talks about. Because here's what I've noticed. Most financial content talks about money like it's a linear scale. More is better. Keep going. Stack more. But the truth is, each level of wealth is almost a different game entirely. Different rules, different dangers, different versions of freedom. And if you don't understand the game you're actually playing right now, you'll optimize for the wrong things. Let's go through every rank, from the very beginning. The $1,000 investor. This is where almost everyone starts. And if you're here right now, I want to tell you something important before I tell you anything else. The dollar amount matters almost nothing at this stage. What matters is that you started. At $1,000, the game is not about returns. A 10% return on $1,000 is $100. That's not going to change your life. What changes your life at this level is the habit. The mindset shift from I spend money to I own things that work while I sleep. But let's be honest about what this level actually feels like. It feels exciting and frustrating at the same time. You're watching your portfolio move $30 up and $40 down, and it feels significant because it is significant relative to what you have. You're probably making some emotional decisions. Selling when it drops, buying something because you saw it trending online. The biggest danger at $1,000 is not losing the money. It's developing bad habits that you carry forward into larger amounts. The $1,000 investor who learns to stay calm, buy consistently, and ignore the noise is worth 10 times the $1,000 investor who's trading on emotion, even if the account balance looks the same. The $5,000 investor. This is the first real inflection point. At $5,000, you have enough to actually feel the effect of diversification. You can own a broad index fund and have exposure to hundreds of companies at once. The game at this level is still mostly about savings rate. How much you're adding each month matters far more than which stocks you pick. Someone adding $500 a month to a boring index fund will vastly outperform someone with a $5,000 balance who isn't adding anything and is trying to pick winners. But something psychological shifts here too. $5,000 starts to feel real. It's a number that would hurt to lose. And that feeling, that first real sense of something to protect, is actually useful. It's the beginning of investor psychology. The $10,000 investor. Welcome to 5 figures. This feels like a milestone because it is one. At $10,000, you start to feel the actual power of compounding for the first time. At 10% annual returns, this account grows by $1,000 a year on its own without you doing anything. That's not retirement money yet, but it's no longer nothing. The trap at this level is overconfidence. You've made it to 5 figures. Maybe you had a few good trades. Maybe the market ran in your favor. And now you start to think you understand this game better than you do. This is when people start concentrating positions, putting $4,000 into one stock they really believe in, taking tips from friends, dabbling in options without fully understanding how they work. I've seen $10,000 accounts go to $2,000 in 3 months at this stage. Not because the investor was stupid, because they graduated from beginner's luck into intermediate overconfidence, which is actually the most dangerous place to be. Stay boring at $10,000. You're building a foundation. The foundation is not the exciting part. It's the most important part. The $25,000 investor. This is where the math starts to feel genuinely motivating. At $25,000, with a 10% annual return, you're earning $2,500 a year from your portfolio. That's a car payment, a vacation, real money that didn't come from your job. At this level, the conversation starts shifting toward tax efficiency. Are you maxing your tax-advantaged accounts first? Do you understand the difference between a traditional and a Roth account? Are you paying unnecessary capital gains taxes by trading too frequently? The $25,000 investor who is tax smart will significantly outperform the $25,000 investor who isn't over a 20-year horizon. This is also the level where the social dynamics of money start getting interesting. You have enough that you feel the temptation to tell people about it. Or, conversely, you start noticing how much your friends spend and feeling quietly smug about your discipline. Both are traps. Stay focused on the goal, not the scoreboard. The $50,000 investor. $50,000 is the first number where a lot of people start to feel genuinely financially stable. Not rich, but stable. At $50,000, you have real options that people below this number don't. You have a meaningful emergency fund equivalent. You have enough to serve as a house deposit in many markets. You have enough that a financial advisor will actually take you seriously as a client. The game at $50,000 is starting to bifurcate. Some people at this level are here because they saved aggressively on a normal income. Others are here because they had a windfall, an inheritance, a bonus, a crypto run-up that they cashed out. These two $50,000 investors are not the same. The one who built it slowly has the habits. The one who received it all at once is in serious danger of lifestyle inflation, eating it faster than it grew. The question at $50,000 is not, what should I invest in? The question is, what kind of investor am I becoming? Because the identity you build now will govern every decision you make at the higher levels. The $100,000 investor. This is the number that changes the game mathematically. $100,000 at a 10% annual return is $10,000 per year. That's $833 a month generated by your portfolio. For the first time, you can genuinely feel what it means to have money making money. It's no longer theoretical. It's a number you can see growing in real time. Something else happens at $100,000. The psychology of money shifts. Below this number, saving rate is the dominant lever. What you earn and what you cut matters more than any investment decision. At and above $100,000, return rate starts to compete with savings rate as the thing that matters most. The investment decisions you make with this amount of money actually move the needle. This is also the level where a lot of people make their first serious mistake at scale. Concentrated bets that seemed reasonable at $10,000 now mean you're wagering $20,000 or $30,000 on a single position. The same mistake costs 10 times more. The $100,000 investor who stays disciplined, diversified, and patient is setting themselves up for something extraordinary in 20 years. The one who swings for the fences at this level often ends up starting over. The $250,000 investor. $250,000. This is the first level where, depending on where you live and how you structure your life, you can start thinking in terms of partial freedom. At $250,000 generating 10% annually, you have $25,000 a year in returns. In many parts of the world, that covers basic living expenses. Not comfortably, not in a major city. But the seed of financial independence is visible here for the first time. The investor at this level starts encountering a new category of problem. What to do with it? Do you keep it all in index funds? Do you start looking at real estate? Do you diversify into bonds as you get older? Do you think about private investments? At $250,000, the complexity of wealth management increases significantly. And this is where bad advice starts to get expensive. This is the level where fee-only financial advisors start making sense to consult with seriously. Not to hand your money to someone and forget about it, but to stress test your thinking with someone who's seen the mistakes people make at this level. The $500,000 investor. $500,000. This is the number that a lot of people quietly think of as the threshold between doing well and genuinely wealthy. And the truth is, it depends entirely on what you do next. $500,000 at 10% is $50,000 a year. For a single person with low expenses who owns their home, that's financial independence. For a family of 4 in a major city with a mortgage, it's a very nice supplement to income. What changes dramatically at this level is other people's behavior toward you. Financial professionals start calling. Investment opportunities appear. Friends start asking about advice or, occasionally, money. Family dynamics shift in ways nobody prepared you for. The $500,000 investor faces a new challenge: being a target. Not in a dramatic way, in a quiet, socially acceptable way. Fee-heavy investment products suddenly seem worth explaining. Business opportunities from people in your network conveniently appear. The number of people who just want to grab coffee increases. Protecting your capital at this level is as important as growing it. The wealthy don't just build, they defend. The $1 million investor. $1 million. For most of human history, this number meant rich. In 2025, it means something more complicated. $1 million invested at 7% real returns produces roughly $70,000 a year before tax. That's a solid income. But it's not private jets and no limit credit cards. It's a comfortable, stable, relatively free life, if you live below your means. What actually changes at $1 million is not the lifestyle, it's the identity. Something shifts when you cross this number. The urgency fades. The frantic energy of accumulation softens. You start thinking less about making money and more about keeping it, deploying it well, and what it's actually for. The millionaire's biggest enemy is lifestyle creep dressed up as reward. You made it. You deserve the nicer car, the upgrade, the renovation. And before you know it, $1 million becomes $800,000, and the psychological finish line keeps moving. The discipline required to get to $1 million is not the same discipline required to stay there and grow beyond it. Many people make it to the number and then quietly drift back. The $2 million investor. At $2 million, something important happens. Optionality. You now have enough capital that you can genuinely choose what you work on. Not just, I could technically retire if I lived frugally, but real choices about how to spend your time. $2 million at a conservative 5% return is $100,000 a year. At a 7% return, it's $140,000. Those are numbers that support a genuinely free life for most people in most places. But here's what the $2 million investor often discovers. Freedom is harder than accumulation. When you had a target, the path was clear. Save more, invest more, watch it grow. The goal gave you structure. At $2 million, the structure disappears, and you have to create it. What are you working toward now? What gets you out of bed? What does success look like when the financial goal is achieved? This is the level where people first seriously encounter the question that money can't answer. What's the point? The investors who thrive beyond this number are the ones who had an answer to that question before they arrived here. The ones who didn't often find that $2 million feels surprisingly hollow, and they either keep chasing numbers that don't satisfy, or they find meaning outside the portfolio entirely. The $5 million investor. $5 million. This is the number where, for most people in most circumstances, money is no longer the binding constraint on their life. Below this number, even if you're wealthy, you are still making decisions with money as a significant factor. You compare prices. You think about whether a purchase is worth it. You track your spending with some level of attention. At $5 million, those frictions mostly disappear. You fly business class without doing the mental math. You choose where to live based on where you want to live. You choose work based on what you find meaningful, not what it pays. You give generously without it feeling like sacrifice. The constraints don't vanish, but they shift. The $5 million investor now spends their mental energy on completely different problems. How to structure wealth across generations. Tax optimization at a level that requires actual lawyers and accountants, not software. How to give money away intelligently. How to make sure the people around them relate to them as humans rather than as a source of funds. The problems of significant wealth are real. They're just different problems from the ones you have right now. The $10 million investor. $10 million. At this level, the word investor almost becomes inaccurate. You are now an institution, operating at small institution scale. $10 million at a 5% return generates $500,000 a year. You cannot outspend $500,000 a year without genuinely trying. The person with $10 million is not richer in lifestyle terms than the person with $5 million in any meaningful way that shows up in daily life. They eat at the same restaurants, fly the same class, live in comparable houses. What $10 million buys above and beyond $5 million is permanence, access, and legacy. Permanence, because this amount of wealth is genuinely multi-generational if managed even moderately well. Access, because at this level, doors open that don't open below it. Investment opportunities, connections, influence. And legacy, because $10 million gives you the ability to genuinely shape something beyond your own life. A foundation, a cause, a business that outlives you. The $10 million investor's primary job is no longer accumulation. It is stewardship. Deciding what this capital is for, who it serves, what it builds, what it protects. That's a different job from anything we've talked about up to this point. And very few people are trained for it. So here's what I want you to take from all of this. Every level of wealth is a different game, different skills, different dangers, different versions of the question, what is this money for? And the mistake most people make is playing the game at level 2 with the strategies for level 6, or arriving at level 7 with the psychology of level 1. The skills that get you from $1,000 to $25,000 are discipline and consistency. The skills that get you from $25,000 to $250,000 are tax efficiency and patience. The skills that get you from $250,000 to $1 million are risk management and staying boring. The skills that carry you beyond the million are identity, clarity of purpose, and an honest answer to the question of what the money is actually for. Wherever you are on this ladder right now, the most important thing you can do is understand the game at your level, not the level above. Not the level you read about in books about billionaires. The actual game in front of you today. Master that. Advance. And then learn the next game. Because the investor who understands where they are is always more dangerous than the one chasing somewhere they aren't. If this video gave you a clearer picture of where you are right now, drop a comment below and tell me your current level. Not to brag, not to compare, just to be honest with yourself about the game you're in and what it actually requires. And if you want to go deeper on what the $100,000 milestone specifically requires to cross it, I've linked that video in the description. It's the inflection point most people underestimate. See you in the next one.